7 deadly sins. For centuries, they were warnings about spiritual destruction. Today, Charlie Munger understood them as warnings about financial destruction. These aren't moral failings. They're psychological patterns that systematically destroy wealth, relationships, and rational decision-making. Munger didn't study these sins in religious texts. He studied them in boardrooms, trading floors, and bankruptcy courts. He watched brilliant people, CEOs, doctors, lawyers, make catastrophically stupid decisions because they couldn't control these ancient impulses. The market doesn't care about your moral character, but it ruthlessly punishes these psychological weaknesses. Every bubble, every crash, every financial disaster can be traced back to one or more of these 7 patterns. Today, you'll learn to recognize these sins in yourself and others. You'll understand how they operate in modern life. And you'll discover Munger's strategies for building immunity against the psychological forces that destroy most people's financial future. This isn't about morality. This is about survival in a world designed to exploit your weaknesses. Pride is the deadliest sin in financial markets because it disguises itself as competence. Meet Masa Son, brilliant entrepreneur, built SoftBank into a technology empire. At his peak in 2000, he was worth $76 billion, the richest man in the world. His pride told him he understood technology better than anyone else. His success in telecommunications convinced him he could pick winning startups with supernatural accuracy. So he created the Vision Fund, $100 billion to invest in the future. WeWork, Uber, countless unicorns that looked brilliant on paper. Result? He lost $50 billion in 2 years. Pride had convinced him that his past success guaranteed future success in completely different domains. This is the overconfidence trap. Success in one area creates dangerous confidence in unrelated areas. Your brain can't distinguish between earned confidence and transferred arrogance. Doctors who save lives think they can pick stocks. Engineers who design systems think they can time markets. Lawyers who win cases think they understand economics. Each profession rewards intelligence differently, but pride convinces you that your intelligence transfers everywhere. Munger saw this constantly. Smart people using their analytical abilities to justify bad decisions. The smarter the person, the more sophisticated their rationalization. Pride makes you believe your success was entirely due to your skill, rather than a combination of skill, timing, and luck. This misattribution leads to catastrophic overconfidence when facing new challenges. The cure for pride isn't humility, it's accurate self-assessment. Knowing exactly what you're good at and what you're not. Staying within your circle of competence and admitting ignorance outside of it. Munger's approach: I'm no genius. I'm smart in spots, but I stay around those spots. Pride wants you to expand everywhere. Wisdom keeps you concentrated where you actually have an edge. Envy is the most modern of the deadly sins because social media has weaponized comparison. 2021. GameStop mania. Reddit traders watch some random guy turn $50,000 into $50 million with meme stocks. Screenshots everywhere. Success stories going viral. Suddenly, doctors, teachers, engineers, responsible people with stable careers start gambling their retirement accounts on options and crypto. Not because they understood the investments, but because they couldn't bear being left out. Envy doesn't make you want what others have. Envy makes you destroy what you have, trying to get what others have. The comparison trap works like this. You see someone else's highlight reel and compare it to your behind the scenes. Their gains look effortless. Your struggles feel overwhelming. So you abandon your plan to copy theirs. But you never see the full picture. You don't see their losses, their stress, their sleepless nights. You don't see the hundreds of other people who tried the same strategy and failed. Munger and Buffett were mocked during the tech boom of the 1990s. Their returns lagged behind tech-heavy portfolios. Financial media questioned whether they had lost their touch. A less disciplined investor might have abandoned their strategy out of envy. They might have bought tech stocks just to keep up. But Munger understood that comparing results to others was pointless. Their job wasn't to beat everyone else every year. Their job was to compound wealth over decades. When the bubble burst, those who had chased performance out of envy suffered catastrophic losses. Meanwhile, Berkshire's patient, unfashionable approach suddenly looked brilliant again. Envy makes you play someone else's game instead of your own game. It makes you optimize for short-term appearances instead of long-term results. The antidote to envy is creating your own scoreboard, defining success on your own terms, and measuring progress against your own goals. Munger's wisdom: focus entirely on your own game. Stop paying attention to what others are doing. Celebrate others' victories without feeling threatened by them. Wrath in financial markets isn't screaming or throwing things. It's making decisions based on anger instead of analysis. March 2020. Markets crash 40% in 4 weeks. John, a successful software executive, watches his portfolio lose $200,000. He's furious at the virus, furious at politicians, furious at the market for being manipulated. His anger demands action. He sells everything at the bottom to show them he won't be a victim. 6 months later, markets recover to new highs. His anger cost him $300,000 in missed gains. This is revenge trading, making decisions to punish the market for hurting you, as if the market cares about your feelings. Wrath makes you personalize impersonal forces. You think the market is out to get you. You believe your losses are someone's fault. So you make decisions to prove you're right instead of to make money. Day traders lose money on a trade and immediately double down to get even. Real estate investors overpay for properties because they're angry about being outbid previously. Cryptocurrency traders FOMO into positions because they're furious they missed the last pump. But markets aren't personal. They don't remember you. They don't care about your feelings. They just reflect the collective decisions of millions of people. Munger understood this deeply. He said investing is more about temperament than intelligence. Smart people can analyze what's happening, but emotional control determines whether you can act on that analysis. The cure for wrath is emotional distance, treating investments like a business rather than a personal relationship. When Berkshire stock goes down, Munger doesn't get angry at the market. He asks, is the business worth less, or is this an opportunity to buy more? Wrath makes you reactive. Wisdom makes you responsive. Sloth isn't physical laziness. It's intellectual laziness, the refusal to think independently. 2008. Millions of people bought houses they couldn't afford with mortgages they didn't understand because everyone else was doing it, and real estate always goes up. They didn't read the mortgage documents. They didn't calculate whether they could afford the payments if interest rates rose. They didn't research historical real estate cycles. They just followed the crowd because thinking was too much work. This is intellectual sloth, outsourcing your thinking to others instead of doing your own analysis. Modern examples are everywhere. Following hot stock tips from social media without research. Buying crypto because influencers said so. Investing in whatever is trending without understanding what you're buying. Sloth feels efficient. Why spend hours researching when you can just copy what successful people are doing? But you're not copying their strategy. You're copying their actions without understanding their reasoning. You don't know why they bought, when they'll sell, or how their decision fits into their overall plan. Munger spent decades studying businesses, reading annual reports, understanding competitive advantages. Not because he enjoyed homework, but because independent thinking was his edge. Most people won't do this work. They want shortcuts. They want someone else to tell them what to buy. But shortcuts in thinking lead to shortcuts in results. The antidote to sloth is intellectual curiosity, reading widely, asking questions, thinking for yourself instead of accepting conventional wisdom. Munger's approach. I constantly see people rise in life who are not the smartest, sometimes not even the most diligent, but they are learning machines. Sloth makes you a follower. Curiosity makes you a leader. Greed isn't wanting money. Greed is wanting money so badly that you take stupid risks to get it. Bernie Madoff, brilliant financier, chairman of NASDAQ, respected in every financial circle. He could have retired with hundreds of millions earned legitimately. But greed whispered, why settle for hundreds of millions when you could have billions? So he built the largest Ponzi scheme in history. $65 billion stolen from investors who trusted him. Result? Life in prison. His son's suicide. His family's name destroyed forever. Greed made him risk everything he had for more of what he didn't need. This pattern repeats constantly. People with enough destroy themselves, chasing more. Day traders with profitable strategies blow up their accounts using leverage to amplify returns. Real estate investors who built wealth slowly lose everything, trying to scale faster with debt. Crypto millionaires who could retire comfortably lose everything chasing the next 100 times gain. Greed makes you impatient. It makes you believe that enough doesn't exist. It convinces you that slow and steady is for losers. But Munger and Buffett built their fortune through patience, not greed. They could borrow billions to amplify their returns, but they rarely use significant leverage. Why? Because they understand that greed turns mistakes into disasters. A 20% loss without leverage is recoverable. A 20% loss with 5 times leverage is bankruptcy. The Moore trap works like this. Every success makes you hungrier. For bigger success, every gain feels insufficient compared to what you imagine is possible. Social media amplifies this trap by constantly showing you people who made more, faster, with less effort. The antidote to greed is defining enough. Knowing what you actually need versus what you want. Optimizing for sustainability instead of maximum returns. Munger's wisdom: the big money is in the waiting, not in the chasing. Gluttony in modern life isn't overeating, it's overconsumption, inflating your lifestyle faster than your income. Mike Tyson earned $300 million during his boxing career. At his peak, he was making $30 million per fight. But his lifestyle grew even faster. Mansions in every city, dozens of cars, private jets, tigers as pets, entourages of hundreds of people. His spending outpaced even his massive income. By 2003, he was $23 million in debt and filing for bankruptcy. This is lifestyle inflation, the tendency to increase spending whenever income increases. You get a promotion and immediately buy a bigger house. Your business does well, and you lease a luxury car. Your investments gain 30%, and you book an expensive vacation. Each upgrade feels reasonable in isolation, but collectively, they create a lifestyle that requires your peak income to maintain. What happens when income drops? When markets crash? When business slows down? Suddenly, your lifestyle becomes a prison of fixed expenses. Munger observed this pattern in countless wealthy people. They earned millions, but lived paycheck to paycheck because their expenses grew with their income. The hedonic treadmill ensures that each upgrade provides only temporary satisfaction. The new car feels amazing for a month, then becomes normal. So you need another upgrade for the same feeling. Meanwhile, people with lower incomes but controlled expenses build actual wealth because they live below their means. The antidote to gluttony is intentional lifestyle design, consciously choosing what upgrades actually improve your life versus what just inflates your expenses. Munger's approach: focus on experiences and relationships that improve with time, not possessions that depreciate. Gluttony makes you a slave to your expenses. Discipline makes your money work for you. Lust in financial markets is addiction to excitement, confusing activity with progress. Jim Cramer, Mad Money host, screaming, buy, buy, buy. Every day, new hot stocks, constant action, pure financial entertainment. Studies show that people who follow his recommendations lose money consistently, not because he's stupid, but because constant trading destroys returns. Yet millions watch because his show feeds their lust for excitement. Investing should be boring. Buy good businesses at reasonable prices and wait. But boring feels like you're not doing anything. So people day trade. They constantly check prices. They buy and sell based on news, rumors, feelings. This isn't investing, it's gambling disguised as investing. The lust for excitement makes you mistake volatility for opportunity. You think dramatic price movements mean dramatic profit potential. But volatility is just noise. It has nothing to do with actual business performance. Cryptocurrency amplifies this lust because prices move so dramatically, 10% swings daily. Stories of overnight millionaires, constant drama. Traditional stock investing feels boring by comparison. Who wants 8% annual returns when crypto promises 800%? But most crypto traders lose money because they're trading excitement, not value. Munger and Buffett made their fortunes through boring consistency. They bought Coca-Cola and held it for decades. They bought Apple and let time compound their returns. No drama, no excitement, just patient capital allocation. The antidote to lust is boredom, building systems that work without constant attention, finding satisfaction in long-term progress instead of short-term thrills. Lust makes you a gambler, patience makes you an investor. The 7 deadly sins aren't moral judgments, they're psychological patterns that humans evolved over millions of years. Pride helped our ancestors compete for resources. Envy motivated them to acquire what others had. Wrath protected them from threats. In ancient environments, these emotions were survival tools. In modern financial markets, they're systematic destruction tools. The market doesn't reward evolutionary instincts. It rewards rational behavior that often contradicts what feels natural. When everyone else is greedy, you should be fearful. When everyone else is fearful, you should be greedy. This feels wrong emotionally, but it works financially. Munger's genius wasn't eliminating these psychological patterns, it was recognizing them in himself and building systems to counteract them. He studied his own biases like a scientist studying specimens. He created checklists to prevent emotional decisions. He built partnerships with people who complemented his weaknesses. The goal isn't perfection, the goal is awareness. When you feel the urge to chase a hot stock because everyone else is making money, envy, you recognize the pattern and pause. When you want to sell everything because markets are crashing, wrath, you recognize the emotion and ask, is this rational or reactive? When you're tempted to use leverage to amplify returns, greed, you remember that smart people with leverage become poor people faster. Self-awareness becomes your competitive advantage in a market full of people who don't recognize their own psychological patterns. The 7 deadly sins will always exist within you. That's not a flaw, that's human nature. But recognizing them gives you the power to choose rational responses instead of emotional reactions. And in financial markets, that choice is the difference between building wealth and destroying it. Munger's final wisdom: I've gotten rich by avoiding stupidity rather than seeking brilliance. The 7 deadly sins are 7 forms of stupidity. Avoid them, and you're already ahead of 90% of investors.